Are you ready to take your small trading account to new heights? Imagine achieving rapid wealth accumulation even with an account size less than $5,000. In this video, I'm going to share the ultimate options trading strategies that are beginner friendly and designed specifically for small accounts. But before we dive into the specific strategies, let's understand why small trading accounts requires a different approach. Small accounts come with the one unique challenge of limited capital, but they also present exciting opportunities. Here are the key principles and mindset required to make the most of your small account trading. First, we have to talk about proper risk management because it is essential to stay in the game as long as you can as a small account trader. What we don't want to do is risk too much on one single trade. So a good rule of thumb for new traders out there is when you're trading, look at your risk percentage, 1, 2, 3, 4, 5. Don't want to go over 5% for any given trade. So if you have an account of $1,000, you're kind of limited in the amount of trades that you can make, but don't worry, we're going to show you some very easy ways to implement your trading, even with these smaller account sizes. The key thing here is to not risk more than you're affording to lose. If you have a 5% trade out there, the next trade you should make should be no more than 5% again. This way, if this trade doesn't work out, you're down 50 bucks and you're not losing the whole $1,000. Again, if you scale up from 1,000 to 5,000, you have a little bit more room, a little bit more margin for error. But again, you're still losing a percentage amount based on your risk management. You're not going to lose $300, $400, $500 with your account being $5,000. You want to live to fight another day and use these smaller increments. If it's 3%, 2%, just have a mix of kind of percentages on your trades. If you have a really good feeling for a trade, yeah, maybe you dial it up and you go to 5%. If you're not really sure on another trade, you want to kind of just get in there. You think it might work out, maybe you're down closer to 2%. But the key here is to manage your risk and not use more than these kind of areas here shown in this chart. Once you have an idea of how to manage risk at 1,000, 5,000, you can add more money to your account and scale up to 10, 15, 25. But understand this. If you can't make money with a small account like $1,000 or $5,000, there's no reason for you to add money to your account and try to make more with more money in your account. That's just going to equal more money, more problems. You want to manage capital appropriately first in these smaller account sizes and get started. Once you have your setups, you have your strategies, you have your risk defined, then you add more money once you have some success and implement those strategies on a larger scale. We also want to use what's known as risk-defined strategies in the options trading world. So these are specific types of options trade that give you a predetermined amount of loss and potential profit. Doing this gives us a much better chance of hitting those 1%, 2%, 3%, 4%, and 5% metrics on our risk chart and not putting up too much capital in the game. It's very clear and easy to identify how much we're putting into each trade, what the potential payoff is, and the risk associated with that. Now let's unveil the top options trading strategies for those of you with small trading accounts. And these are ones that have been handpicked and tailored specifically for you based on the limited amount of risk and the potential reward long-term with these strategies. So the first strategy is known as a credit spread. And here's an example Interactive Broker showing you how it works. What you want to do is pick your expiration date and then pick two different strike prices. You're going to sell a put and then buy a put, giving you a strategy known as a credit spread. Here's how it looks. We're going to go ahead and look at this August 18th expiration date. We want to sell this first put at a level we do not think AMD is going to go below. So based on the daily charts here, I'm looking at a level here, let's say 106, 105. Let's say 105 is the level there from this recent support. We're gonna go a little bit below that and give ourselves a little bit of a buffer just in case and go at the 100 level put. We're gonna sell this put right there. We're also gonna put on our strategy builder to build out this strategy for us. So we have our first leg in here at August 18th, the 95 put, we wanted the 100 put. So let's click on that, put the 100 put in there. Take this one away, 100 put. We would then go ahead and buy another put lower than the current 100 strike. This will give us our credit or a bunch of cash coming into our account. And if we go down to 95, so we've got both of our legs in the trade now. You can see here the middle right there, the bid ask is between $84 and $91. So somewhere around that range, let's call it $87. We're gonna get paid to do this. So we get paid $87. And our maximum risk on this trade, if we go into the margin impact and the advance, let's go to 87 here for our credit here, $87. That's what it looked like right there. If we go into our advanced tab, margin performance profile. So we can see here in our performance profile, we have a profit probability of 81% So 81% chance we're gonna hit this $85 and take that home. We have a max loss showing there of 416. One way you can avoid taking on the max loss is by using a stop loss and putting your stop loss in at that risk parameter we talked about. If you have an account that's $10,000 in capital and you want to put a 5% stop loss on this trade, well, 5% of $10,000 is $500, right? So you could put that stop loss on if you wanted to, or you could let this trade ride out. It would still be underneath your 5% max kind of risk for a trade rule, but your probability percentage is very good and you don't need a lot of capital to make this trade happen. It only takes up $664 of your margin, which is a great low impact trade for your account. You get paid that $87, your account goes up in value, and away you go selling your first credit spread. Our second example is one where you want to look at a stock that you think is going to stay in between a certain range at a certain expiration date. It's known as an iron condor. And what this involves is looking at a stock here. We're going to look at Apple and build it out here with the strategy builder again. What we want to do is just do what we did with the credit spread and sell and buy that put, but also sell and buy a call option and use our other side of the options chain to make a little bit more profit as well, with still predetermined risk. So we open up Apple's chart and say it's not going to go below 185. It's not going to go above 195 within the next kind of month. If those are our parameters, we go back into our options chain and we say, hey, okay, we've got 41 days till expiration. That's great. We've got our 185 on the low end. So we would sell our put there. We would buy the 180 to kind of create that credit spread like we just talked about. And then on the other side, we've got that 195 area. We would sell that call and buy the 200 call to build in our full iron condor. So you can see in our strategy builder, we have that 185 and 180 put. We're selling one, buying the next. We are selling this 195 call, buying the 200, and it creates this iron condor with a profit being paid into our account right away between $3 and $2.90 and $2.79 per contract, which is 100 shares, which you multiply by 100 again, and this gets you to around $2.90, so $290 of profit for your iron condor. Opening up our margin performance area, let's go 290 right here, put this in so we have that loaded, 290, okay, click advanced. Margin performance, let's get our profile going again and see what the risk parameter is on this trade. This one's great because you can really monitor the risk, and if you get those technical levels right on, you have a great chance of making profit. And even if you don't, our max loss here in this trade is capitalized at $219. That's all we're putting up in this trade because of the way we structured it. Again, the margin impact is only $664. So if you have a small account, if you had a $5,000 account right now, this will only be taking up just under 5% of your potential risk on this trade. If you wanted to push this number above 50, we can just go back and edit our stock leg and show you how to do that. We would just take out our initial first leg there. We want to go and just move this down from, we had 185 before. We're going to go down to 180. Let's sell that one. We're going to sell that one. We're going to buy this 175, giving us a little bit more of a buffer. And we're going to change this one here on the call side. We're going to take those out as well. You can edit them in here as well. We're going to move this one out and go 200 is the sell leg and the buy leg of 205. We have our iron condor. Our profit potential goes down, right? We're only at 180, let's say right now. But if we scroll down here, let's put 180 in, negative 180. And again, pop open our advanced tab. Our profit potential or probability should go up in our performance profile. And it has now gone up above 60%. But also doing that, our potential max losses also increase. So we have better odds of winning the trade, smaller profit potential. We do have a wider kind of spread here on our calls and our puts. So we have a little bit more potential loss on our trade. But again, same margin impact. If this fits your risk parameter and this is a okay profitable return for you, go ahead and make this trade with your small account. It's a great way, again, to manage stock price when it goes from a certain high and a low, and you think it's not going to go below those ranges or above them. It's going to stay inside those ranges. This is a strategy you want to use. And the last strategy is known as buying calls. And this is the one you probably heard about the most, or you may have some experience with your beginner trader. Basically, what you want to do is find a stock that's on an uptrend. Amazon's chart for the last couple months has been just going bonkers upwards, which is a great kind of sign. Most of the market's been this way, especially tech. If you want to buy call options, you have to get the direction absolutely right. So that's the crucial first part. You also want to go out a little bit in time and give yourself a bit of time for this trade to work. Let's go back out to August 18th again. And if you wanted to buy a call option here on Amazon, here we go. We could do this. If you didn't want to put up this much cash, you could go a little bit further out, and you could see that we could go down here and say, let's buy these call options. We're putting up $100 of capital right here to buy this call option at 150. And again, we'd have to get to a certain price for the stock. We would put up the capital here, 103, let's call it. And we go to our advanced tab for doing buy this call option, margin performance. So in this example, we have a probability percentage of 11%. If you get the price action right and Amazon stock does move up, you're going to make some cash. Here's some examples down here, plus 10% for the stock price, you're making $300. If it goes down, obviously you're losing everything that you put into it. But the good one with call options is that your loss is capped here at that 106, which you chose to pay for this call option. So your risk is defined up front. If you wanted and thought Amazon was about to boom and this $100 loss was okay for your account, you can buy this call option and hopefully ride it up to profit. You can also use a stop loss to limit this 106 and not lose the whole amount if you want to do so, or you can pick a different strike price and get a different odds of profitability. If we go a little bit closer to the current price of Amazon, and let's get up here right around this 135, it's currently selling at 130. Let's go 135 and buy those ones, 440, that's fine, yeah, reset it. So between 440 and change, let's go and just say it's gonna be 4.25 or 430. Advanced tab, margin performance. So in this case, we have a probability of closer to 30%, which is a little bit higher, right? We have to pay for that though. Our max loss here at 443. If you want to kind of parlay that down, you put a stop loss and maybe stop it out at about 50%. You can keep $200 and risk 243, which may line up better for your small trading account. When you get the direction right, again, you're making bank with an infinite potential return. If the stock price just keeps going on a rip to the moon, you're making good profit here buying a call option. But you have, again, your risks defined up front. You know what you're putting into the trade capital-wise. You know what has to happen for the value of this contract to go up and make money for yourself. If I was starting over again with a small account, I'd be looking for high probability trades and utilizing credit spreads first, then progressing to something like an iron condor or buying calls after I became more comfortable. But start small, start with these smaller risk-defying strategies, understand your numbers for your account size, and do what feels comfortable to you. If you're a 1% trader, that's great. If you're a 5% trader, that's great, but do not exceed these tolerances as a beginner until you understand more of what's happening and more of your trading setups and strategy as you get more experience. Setting up your actual trading account, whether it be on the computer or your phone, is also massively important, as options trading can be a quick in and out game at times. Here are the key settings you need to have for options trading when using interactive brokers.